Hey traders, hope you're all doing well. If you went short this last week, you probably did do pretty well. And if you went long, you did not do so well because almost everything has been down all week long. And if you're watching this video right now, it means that you follow the stock market, and that means that you already know this, so I don't have to tell you that. I did have one long position that worked out for me this week, and surprise, surprise, it was Lockheed Martin, because as I said in an earlier video, who makes money in war? Defense contractors. So I opened a long position on LMT, closed it out today for a very modest gain. It was only $100 and something, so definitely didn't get rich on that one, but I mean, that's, pretty amazing that you could make money on anything going long this week because everything was so rough. But I did do well on a number of other short positions. Closed out my DJT short on Tuesday, the last DJT contract that I had on Tuesday. And those contracts made me a few $1,000s since I opened them. So that was a very good move. And then I had another AMD short that worked out today. But the point of this video today is not to break down specific trades, but it's more looking at one particular thing that could have helped you all week long if you had just paid attention to it. And it's so simple. And I think that a lot of times people get confused because when, like the normal news will say, oh, the stock market's crashing, it's terrible, it's, stocks are doing awful. They make you believe that you can only make money if you go long. And this is so far from the truth. You can make tons of money going long or short. The strategy doesn't change. It's only the direction in which you're going that changes. So when you see certain things shaping up on the chart, whether it's to the upside or to the downside, you just pay attention to those particular things. It's not like you can't get involved when everything's tanking. You can absolutely get involved when the whole market is tanking, and you just wait for that little moment for price to creep up just a little bit to the point where you go, okay, we've retraced, now I'm going to get in short and ride it down for further profits. And that's what you could have done all week long just by looking at the 200 EMA. And I'm going to do a screen share where I put up the 200 EMA and just show you how easy it would have been and just how it's like right there in front of your eyes. One thing that I say in my book and in my video course is that too many people get too hung up on trying to predict the future. And so you'll see so many articles or videos or whatever, people talking about where's it going to go next? Where's it going to go next? Everybody's always focused on what's next. But the point is, you can see what's happening right now. You can always see what's happening right now. Like the now is right there in front of you on the screen. And so if you just simply focus on the now and stop worrying about where you think it's going to be tomorrow or the next day or the day after that, you've got so much of a better chance of actually really cashing in on the move, because the move is already happening and you just jump in as the move is happening and profit as you're taking the ride, whether you're going up or down. And so I'm about to show you how the 200 EMA is really, that's like that's the one indicator that I always have up on every single chart, even though I'll change up and I'll look at different indicators on different time frames, and I'll I'll check the Bollinger Bands or the Keltner channels or a number of different things just to give myself more pieces of information to consider. The 200 EMA is the one where, like, if the trading gods came down from the heavens and said, you can put one indicator on your charts from now until the end of time, which one will it be? I would absolutely, without a doubt, choose the 200 EMA because that's the one that you can most confidently use to predict whether something is going to continue or if it slices through the 200, then you know that there's actual real strength in a reversal as it happens. So let's check out the 200 EMA and I'll explain a little bit further in depth what I'm talking about. Okay, here we are taking a look at the AMD chart. We've got the 15-minute chart over on the left-hand side and the 1-minute chart on the right-hand side. And I'm going to show you just how important and easy it is to follow along with price action with the 200 EMA and how you can really just use that as a guide to keep you kind of going in the right direction as long as things are trending. There is a caveat here. I mean, it's not like a magic bullet. There are no magic bullets that exist in trading. But when certain conditions are present, just paying attention to the 200 can be really all you need to continue on a certain direction, whether you're going long or short. So let's start by looking over here at the right-hand side, the 1-minute chart. This is today. We're right up to the minute here. It's 3:21 p.m. Central Time, so markets have just closed. Where my cursor is post-market action right here. But you can see just today, looking at the 1-minute chart with no other indicators on here, if you had stayed on the right side of the 200 and gone short today, if you had basically identified this moment right here where price comes up, touches, reverses, comes back down, you would have made money all day long. Now, I got in short right here and it went against me for, the next 10 minutes. And obviously that sucked. Like right after I get in short, it pops up like this. But I didn't freak out. I didn't stop out my position. Why? Because the 200 is right here. And, I knew that that was the make or break moment. And we were going to find out what was going to happen at that point. So if price had continued to, tear up through this 200, then I would have given it another probably 3 or 4 minute candles going up before I would have stopped out. But I just waited. I saw this one candle briefly popped up above the 200. Very next minute we fall and then we touch it, rejects, and basically for the rest of the entire day, except for actually not even at the end of the day. We did come up again at the very end of the day, but now I had gotten out my last contract right around here. So I saw this sort of plateau action here, and for a couple of reasons. First reason being it's Friday. I didn't want the time decay to melt me out. If I had waited all the way down to here, I would have made more money on the move, but the time decay would have been hurting me. So, on Fridays, no matter what happens, I like to be out like before noon. And we were getting right around that noon time frame right here. And I saw this nice, strong action down, and I was making money all the way down, just peeling out contracts. So I opened right around here, held, started peeling out as we were coming down, closed out my last contract right around here. So that worked out for me. But, the point of this video is not to talk about individual trades. It's to talk about the existence of the 200 EMA and how you can use that to your benefit. So like I was just saying, we rejected, and at that moment, I just basically was making sure that we stayed below the 200. There was another moment where it briefly popped up above just for a second, but then rejected again. And if you want to look left and follow the action to the left, now this is yesterday. This doesn't really give us a very strong indication one way or another, because it was largely a sideways day yesterday. I mean, we did move up, we moved down, but it was kind of, on a bigger picture, it was a sideways day, not like today, which, if you look at the totality of today, this is obviously a very bearish day. Whereas yesterday, the totality of the day felt more like consolidation. And so when you're dealing with these periods of consolidation, the 200 is not really going to help you out all that much. But when you're dealing with very strong trending action, the 200 will absolutely help you out. So the day before yesterday, once again, almost all day long, very, very solid downwards action. You get this one little part where we briefly, it literally touches the 200 and then it rejects it. So this can show you just how important this level is, and how if you just pay attention to this level on your intraday charts, that can kind of give you a idea of whether you can stay in. So, for example, on this day, if you had gotten in short, it doesn't matter where you got in short. at any point of the day you had gotten in short, you get to this moment, we break up above this. If I was in short here, I would have set a level right around here, because we've gotten so many touches right on this level of right around 156, 157 right here. We've touched so many times right around here. If I was in short and I'm riding this position out, I might see it break this level and I go, oh man, I'm getting a little worried. But then I'm waiting to see how the price reacts with the 200. I would wait and I would see that price then rejects the 200 and comes back down below my level. And, right at this moment, I'd be thinking, okay, cool. I'm still totally on the right side of the trade. So it's sort of a measure of how confident you can be in your position as long as you're on the right side of the trend. So we can continue to move left here. Again, this is a consolidation day. So on days when you're consolidating, it doesn't really help you that much. We're up above it, we're below it, we're above it, we're below it, we're above it. So on days when price action is moving sideways, the 200 doesn't really help you too much. But I don't really like trading days like this anyway. So it's like it's only really helpful on days when I'm trying to be involved. Here again, this is not as dramatic, but once again, you see once we break below the 200, and then especially when we break below this daily low indicator right here, then when we pop back up above it, again, we literally almost touch, not quite, almost, and then we reject it, and reject it pretty hard. So if you were in short here, you could have felt confident about staying in the trade that you were already in short. Once again, a couple days before, you can see how it gets close, rejects it, comes up, touches it, rejects it. We did break through right at the end of the day, but frequently a lot of more volatile stuff will happen right in the last 30 minutes of the day, just like there's more volatility right in the first 30 minutes of the day. So the first and last few minutes of the day, you see extra volatility. Here, this is a lot less of a move, but if you were on the upside here, if you were going long here, you could have played it the same way, like going long all day long and using the 200 as your guide as to knowing when to stay in if you were long. So say, for example, you got on long right here when you saw the price touched and then came up above it. You could have gotten in right here at 167, basically held it all day long until 170. Now, this is not like a massive move, but still, you're making money all day long, and the 200 is a very important support level at this point. Right here, same thing, but going short. You wait it out first couple minutes, first half hour of the day, basically. This is about 9 o'clock right here. As soon as price breaks below the 200 and looks like you're getting some continuation in this area, you could go short. Even though price reverses on you a little bit right here, you're still not freaking out because you've still got this 200 as your resistance level right here, and then it bounces off. You can see it literally touches, bounces off, touches, bounces off. We fall, continue all day long pretty much, except for I think the last couple, about the last 30 minutes of the day we come back up. But pretty much, if you had gotten in short on this day, right when you saw this, fairly decent confirmation that we broke below the 200, let's say you get in short right here at 168. You could have held this all day long and only stopped out when you see that you're breaking up above the 200 again at 165. So you could have been peeling out contracts all the way down and then making money for, three whole points of a move right here. And I could just go on and on and on. Like I said, days where it's more of a consolidation, it's not helping you out as much. It's not really doing much for you right here. But any days where you've already got a trend, the 200 is extremely important as far as like knowing whether you can feel confident in staying in the trade or whether you should start looking to get out. For example, on this day, if we got in long when we came up above the 200 with force right here at 168, we're holding all day long, and then we only would have stopped out our last position when we broke below the 200 right here at 171 approximately. Once again, you've got 2 points of a move throughout a majority of the entire day because you're not sweating. Even when, you get in long here and then you see this action right here. Yeah, it's scary. You're thinking, oh shit, I'm losing money right here. But you're not really worried about it because you didn't come back and break the 200. You can stay in. You might even add if you feel like, you have extra amount of confidence that going long was the right move right here. And then if you had added here, you're loving it at this moment. Comes back down, you could even add again because at this point you would have spotted a trend. You would have seen what's happening throughout the day and basically, been able to like pretty much draw your trend line. And then if we extend this trend line over here, we'd see once we broke this trend, you might think, oh man, I might want to start paying attention. And then you can see right around this moment, we're kind of playing on the 200 and then ultimately it rejects it. And that's definitely when you would have wanted to get out. So that's just how you can look at it on the 1 minute chart for your actual entries and exits. But let's look on the left-hand side on the 15-minute chart. This becomes even more apparent when we look at a slightly longer time frame. So you can see that basically up here you can see the day. So right here where I'm highlighting, this is April 4th. You see right above the cursor, day 4/4/24. If I go over here, 4/5/24. So from April 4th to right now, you could have been short every single day and essentially made money with the exception of one day here on the 11th, where we popped up and we played around above the 200 just for one day. I mean, if you're trying to like go longer time frames and maybe you want to do more of like a swing trading thing, you can even do this on a longer time frame and it'll work. But again, if you're dealing with a intraday type of trading and you're, doing day trading like what I usually do, from, we're looking at 15-minute candles here, from 9 o'clock a.m. on, basically all day long, we are going up. I could have gotten in right when I see this breaking above here, right at about 168, and I could have played it all the way to 170. So getting 2 points throughout the course of an entire day. And let me just zoom back out and move left. I mean, as you can see, there's so many moments where price just touches and then bounces off. Like I said, I mean, it's not a magic bullet. I'm just saying that there are so many ways that you can look at this on different time frames, and it can be sort of a bit of a security to know that you're actually on the right side of something. So right here, when you look at it on this day, March 15th, we shot up massively, but then we just couldn't get above the 200. And then pre-market for the next day, we're above it, but then we fall out the very next day and we're below it all day. So it's just kind of, I bring this up to try to illustrate to you that just with one single indicator, when you learn how to see it and how to interpret the indicator with the price action and take a look at how the price is actually interacting with the indicator, either on a minute chart or even on a longer chart. I mean, we could use whatever time frame we wanted. We could use 30 minutes. If you go to a 30-minute, you see exactly the same thing happens. We get up close to the 200, we bounce off. We get up close to the 200, we bounce off, because we're in a down trend. And so you need a trend to actually have developed in order to put more confidence in this. Like I was saying, if we're consolidating and we're just moving sideways, then whether it pops up or below the 200 makes less of a difference. But when we're dealing with a trending action, it definitely makes more of a difference. Now we went to the hour chart. So, going all the way back to April 1st, you see how we play around with the 200, bounce off, play around, bounce off, and we've just been steadily below the 200 for a long time. But if we come up here and let's extend to 180 days, a whole half of a year. You can even get a more complete visual chart of, like, this is all the way back March 13th right here. From March 13th, you see all the number of times that we just play around getting close to the 200, bounce off, come up, get somewhat close, bounce off, come up through it like for just an hour, bounce off, come up, touch, bounce off. And then on the opposite side of it, I mean, you can see, from February 22nd, all the number of times where we get kind of dangerously close to it and bounce off. And then we get this wild action that just shoots up for these couple of days right here. But again, if we move to the left, all the way back to right now, we're in December 7th of last year. You see how we stay up above the 200 each hour in this chart, and then there's only a couple of days where we come below it, but then you come up above it, you play, bounce off of it. There's a lot more indicators that you want to look at as you're making your overall reads. You never want to just look at one particular indicator as the magic bullet, because there are no magic bullets. It's just, you see how powerful this is as a sort of last line of defense of knowing when the big moves are starting to happen, when you look at it on a longer time frame, and then when you look at it on a shorter time frame, you can see how you can use it for daily action. So like whenever you see a day where we've got kind of a strong trend happening, you can use that as your indicator of whether you can stay confident being in your trade, whether you're going long or short. When you think that it may potentially break against you, it's like a really good last line of defense to add along with all of your other indicators. And so I just wanted to make this video specifically right now because this entire week has been a extremely bearish week. We've been down on just about everything all week long. And so somebody might think to themselves, oh, well, I can't make money in the markets because we've been down all week. And that's completely false. You can make just as much money in a bear market as you can make in a bull market. You just need to be able to read the charts correctly and be able to use all of the tools that you have at your disposal to stay on the right side of the trend. And the 200 is simply one of those tools that does a great job at helping you stay on the right side of the trend, which is really the core of my entire strategy. Okay, we're back. Hope you enjoyed that little breakdown, and I hope that you can see the power of one single indicator and what it can do for you when you put it on your charts and you actually pay attention to it and use it as a very valuable piece of information, as you're considering price action and where to go. So that's it for now. I hope you have a great weekend, and good luck trading next week, and I'll see you soon with some new videos. Bye-bye.